Hello everyone, and welcome back to Capital Gains. Today, we're delving into the world of investing during a recession, and we're doing it the Peter Lynch way. Peter Lynch, for those who might not know, is a legendary figure in the world of finance and investing. He's renowned for his extraordinary success as a fund manager at Fidelity's Magellan Fund and for his simple yet remarkably effective investment philosophy. So, if you're eager to discover how to find good stocks during a recession, this video is for you. And remember, Peter Lynch's wisdom stands the test of time, making it incredibly relevant for today's investors. Before we dive into the core of this video, let's take a quick look at the man behind the philosophy. Peter Lynch is a name synonymous with success in the investment world. He's known for his remarkable track record as a mutual fund manager. During his tenure at Fidelity's Magellan Fund, he achieved incredible returns and significantly outperformed the market. But what makes Peter Lynch truly exceptional is his straightforward, common-sense approach to investing. He believes in keeping it simple, and that's exactly what we're going to explore today. To understand why we're focusing on investing during a recession, let's first clarify what a recession is and how it affects the stock market. A recession is a period of economic decline when GDP contracts, unemployment rises, and businesses struggle. During this time, the stock market often experiences increased volatility, uncertainty, and declining prices. Now, you might be wondering, why would anyone invest in stocks during a recession? Well, here's the secret. Recessions can be prime opportunities for savvy investors, and that's where Peter Lynch's advice becomes invaluable. In this video, we'll explore Peter Lynch's investment principles and discover how they can help you identify promising stocks even when the economic outlook seems bleak. So, stay with us as we unlock the secrets of successful investing during a recession. Now that we've established why investing during a recession can be a promising endeavor, let's explore Peter Lynch's investment principles, which can serve as valuable guiding lights in our quest to find the right stocks. Lynch's approach is all about making investing less intimidating and more approachable for everyday folks like us. First and foremost, Lynch places a strong emphasis on something called fundamental analysis. Don't let the jargon scare you. It's simply about looking deeply into a company's financial health. Imagine it as taking a closer look at a business's checkup report. You want to know if the company is doing well financially, so you look at things like how much money they make, how much they spend, and whether they owe money. It's a bit like checking the financial health of a friend before lending them money. You also want to understand what the company actually does for a living and what makes it special compared to others. It's like knowing your friend's job before deciding to help them with a project. One of Lynch's famous ideas is buy what you know. This is all about investing in things you understand. You don't have to be a financial expert to invest wisely. If you can't explain what a company does in a simple sentence, it might be a sign that it's too complicated to invest in. This is like deciding to support a friend's project because you know exactly what it's about and how it works. Investing should be just as simple and straightforward. Lastly, Lynch encourages us to take the long view. In other words, don't get too caught up in the day-to-day noise of the stock market. Think about the big picture and be patient. He's a bit like a gardening enthusiast who doesn't fuss over each leaf, but focuses on the growth of the whole plant over time. Instead of worrying about the stock market's daily ups and downs, focus on the potential for your investments to grow over the years. To make it all simple, Peter Lynch's approach is all about keeping things down to earth and straightforward. Understand the companies you invest in, choose what you know, and think long term. These principles can make the world of investing a lot less daunting and more accessible to everyone. If you're finding this video informative and engaging, kindly consider hitting that like and subscribe button. Every like fuels the algorithm and greatly aids our channel, and your support is genuinely appreciated. Now that we've grasped the main ideas from Lynch, let's use these concepts to help us find good stocks, especially when the economy isn't doing so well. It's not as complicated as it might sound, and by following a few simple steps, you can make better choices when investing in stocks, even during a recession. The first step is to really get to know the company you're thinking about investing in. This means taking a closer look at their financial reports. These reports are like a company's financial report card. They tell you how much money the company is making, how much they're spending, and whether they owe a lot of money to others. It's kind of like checking someone's bank statements to see if they're in good financial shape. You want to find out if the company is financially healthy or if they're having a tough time. The next thing to do is understand what the company does to make money. In other words, what's their business all about? Do they make a product or offer a service that you really believe in? This is important because if you invest in a company, you're essentially saying you believe in what they're doing. So it's crucial to like and trust what they're selling. If you don't, it might not be a good idea to invest in their stock. Keep an eye on a few important financial numbers. One of them is called the price to earnings ratio, or PE. Think of it as a way to see if a stock is a good deal or not. If the PE is low, it might mean the stock is on sale. Another thing to check is how much debt the company has. Too much debt can be a problem, especially when the economy isn't doing well. Lastly, it's a good idea to look at the people who run the company. You can think of them as the captains of the ship. Have they done a good job in their past jobs? Do they make smart decisions, especially in tough times? You also want to know if their interests are the same as yours as an investor. If they're making decisions that help the company, but not the people who own the company's stock, that's not a good sign. So, in a nutshell, to pick good stocks in a recession, you need to do a little homework. Look at the company's money reports, understand their business, keep an eye on important financial numbers, and check out the folks in charge. These steps can help you make smarter investment choices, even when times are tough. Before you jump into investing during a recession, be aware of the risks. The stock market can be like a roller coaster, and economic uncertainty abounds. Even with Peter Lynch's principles in mind, it's important to acknowledge these risks. One smart strategy to help protect your investments is called diversification. This is a fancy word for not putting all your eggs in one basket. Imagine you have a bunch of different types of ice cream instead of just one flavor. If one melts, meaning if one type of investment goes down in value, you still have some others that are fine. So, diversifying means spreading your investments around different things, like putting some money in different industries, maybe in different countries, or even in different types of investments like stocks and bonds. This way, if one area goes down, your other investments can help balance things out. Diversification is like having a financial safety net. It can protect your investments from taking a big hit when one part of the market isn't doing so well. However, keep in mind that even with diversification, there's no such thing as a totally risk-free investment. To stay on top of your investments, it's crucial to keep an eye on what's happening in the financial world. Think of it like checking the weather before you go outside. You wouldn't want to get caught in the rain without an umbrella, right? So keep informed about what's going on and be ready to adjust your investment strategy if needed. Remember, it's normal for the stock market to have its ups and downs, so don't panic when it gets a little bumpy. Patience and self-discipline are your best pals when it comes to achieving long-term success with your investments. In our journey through investment wisdom, we've embraced Peter Lynch's approach, demystifying complex concepts and translating them into practical everyday language. We've learned the art of stock selection during a recession, focusing on understanding a company's financial health, business model, and the people at the helm. Thanks for watching. If you found this video valuable, please like, subscribe, and share your insights on the current investing realm in the comments below. Your input is appreciated. See you in the next video.